Good morning. I'm Mehdi Sunderji, and welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. As you may remember, Jeff is the founder of the much-loved Huge Insights newsletter, which can be found on Substack at hugeinsights.substack.com. As always, Jeff, you publish on a Sunday night, so your subscribers get a bit of a better start to the week than we do. But here we are, and there's definitely lots to unpack. So, first of all, I want to welcome you to the new platform, Jeff. Thanks for joining us.
It's my pleasure to be here, Mehdi. I really appreciate you having me on the show.
And let's dive right in. I've got a feeling the hedge eye cartoon you have in your weekly piece is indicative of your thoughts. So let's go top down.
Yeah, absolutely. So first, let me just say that we did publish the newsletter on Saturday, the 4th of February. And so it's fresh, hot off the press. It's free to subscribe, and I would strongly recommend viewers that want to get kind of the full Monty of what we're thinking about here to just download that newsletter and read it. It's got a lot of really interesting charts that aren't in this week's playbook. A lot of this stuff is just an amalgamation of things we've been thinking about for the last month, really. And what we try and do at the end of each month is just tie all those thoughts together and, put some narrative around it to, see where we are in that process of thinking. And, what we really concluded is that, while it does appear from a lot of technical data that the market has put in some form of a meaningful bottom, right? We don't think it's the bottom. We don't think that the data supports that the market has put in a bear market low. We think it's an interim low that's preceded a bear market rally of some significance. Let me just point out that we're pretty much at the same level that we were, from trough to peak, as we were from the June-August bear market rally. So it's not like we've done much different. The thing that's really changed, Mehdi, in terms of the technical narrative is that we broke out above the 200-day moving average on a daily, weekly, and monthly closing basis. And that has a lot of technicians scratching their heads going, this looks like it could be a bear market bottom. But, the 200-day moving average really is only important because it's pre-programmed into a lot of charting systems and trading platforms, and everyone watches it. It's just an arbitrary number. There's nothing specific about it. It's never been mentioned in a textbook prior to about 20 years ago. And so it's really just something that Joe Granville came up with, back in the 60s. And, it was kind of his thing for a while, and then people glommed onto it. 200-day moving average is important because it's a long-term trend, right? But, it's kind of curve fitted. And what we would suggest is that people pay more attention to the slope, okay? We're using a regression mean to determine what the trend is. And if we do that, the long-term trend is negative, sharply negative, in fact. And so, we've been thinking about this bear market rally in that context. And we think, there's a couple of ways to explain it. But, I think last week's I would call it a bit of a blow off top into, what was kind of a euphoric response to somewhat dovish commentary from Fed Chair Powell after the FOMC meeting last week. And then, subsequently, pretty disappointing earnings from two of the three big, biggest players in the S&P 500, Apple, Google, and Amazon. Apple seemed to be less bad than the other two. But I think overall, market participants were somewhat confounded by what they heard on the conference calls from Google and Amazon, and to some extent, Apple. Apple's problems seem to be more explainable. But then Friday morning, we got an extraordinary jobs number. And it's really difficult to reconcile that jobs number with the rhetoric coming out of Fed Chairman Powell's mouth just 2 days earlier. And so we've seen several Fed governors walk it back. Most recently, Atlanta Fed President Bostic, who said, we need to investigate this further. Well, one thing that I need to say is that investigate all you want, but employment is one of the lagging series in economic data. So what you're seeing is the past, not what's coming down the pike. And the other thing is the employment number is a number that is revised regularly up to a year later. And so it may very well be the case that 517,000 jobs was some kind of a miscount or misfire. We'll find out. But it also speaks to the idea that the Fed really doesn't know where they are in the slowing process. Okay, monetary policy changes take 6 to 12 months to show up in the hard data, and so they're kind of flying blind here, and we're at least 3 months away from a touchdown in terms of when the midpoint of this tightening cycle starts to impact the hard data. So with that, we continue to expect the market to move lower, and we've been advising our clients to remain cautious, de-risk portfolios, minimize net equity exposure, and raise cash reserves to the maximum level.
So let's get a little bit into the weeds and talk about investor sentiment. It does feel like greed is on the menu at this point.
Doesn't it? I mean, when we take a look at what's leading the charge, it's crypto, it's meme stocks, it's disruptive tech that doesn't have any earnings but was down 95% last year, and it's up 30% this year. But if you look at a long-term chart, it barely shows up on the chart. And so, you got to go up quite a bit to recover that 90% decline last year. And, the 30% rip off the lows here, in conjunction with kind of a January effect, if you will, doesn't quite get the job done. We think a lot of this is just, people trying to buy last year's losers thinking that they're cheap, when just because the price is lower doesn't mean that the valuation is cheap. That being said, there is no doubt that animal spirits have been reawakened. We just put a slide from the CNN Fear Greed Index, which has a nice timeline looking back over the last 12 months, how the investor sentiment has ebbed and flowed, if you will. And if you're not familiar with the Fear and Greed Index, it's got 7 components. They're kind of intermediate term in nature to basically judge investors' behavior, stock market behavior. I'm not going to go into the weeds on it, but the scale is 0 to 100%, 100% being extreme greed, 0 being extreme fear. We were actually very, very close to 0 back in October. We've gotten as high now as 78% and closed at 76% last Friday. That gets us above the extreme greed level, which is 75%. And that's the highest level that we've seen in the trailing 12 months. So in other words, fear and greed, within that context, greed hit a new 52-week high last week. So, with that, I think it's fair to say investor sentiment has recovered from its extreme low.
It does make you think of the old adage that greedy pigs get slaughtered. So let's see what happens. I'm not saying anything one way or the other. I'm just saying that it does make you think that. Volatility. The VIX has been trending downwards, but the VVIX, the volatility index, has been edging higher. Are we coming to a head here?
Usually that signals just that. And in fact, we've talked about this relationship many times in the past. The VIX and the VVIX, tend to basically trend in the same direction until one deviates. And usually when the VIX hits a low and the VVIX starts to positively diverge, and in this case, I think the VIX hit its low on February 1st, the VVIX hit its low on January 6th. And so for the near 30 days in between, VVIX has actually been climbing. And so as we see VVIX positively diverge, historically, that has been an indication that VIX is poised for a major trend change. And it usually precedes a volatility spike. And so whenever we see that, and in this particular case, it seems to be more pronounced than any past case over, say, the past 3 years. And so this greater pronouncement or deviation that we're seeing suggests to me that we're possibly looking at a more significant spike in volatility. It's been our position that the next volatility spike could carry to new highs. We haven't printed above 40% on the VIX in over 2 years now. I think the next volatility spike could carry us back above 40%.
So you touched on it earlier in your opening statement, and we'll get into some of the shorter term levels. But can you discuss, touch on some of the longer term trends first?
Sure. We have a long-term trend following model that we publish regularly. We typically run it on the S&P 500 because that's the benchmark everybody cares about. And when we run it on the S&P 500, we have not seen a positive signal yet as of last night's close. Still have not seen a positive signal. The last signal we received was basically near the March highs, where we received a negative signal, and it indicated the trend had changed. The trend had turned down, and that was an opportunity to sell into strength. And so we, broadcast that to our subscribers, made sure that they were aware that this was a selling opportunity based on that particular model. Well, some people have come back to us and said, Jeff, are you sure the S&P is really the market that we should be looking at? Look at the strength in small caps and mid caps. Look at the strength in some of these other areas of the market. And so, that's a fair statement, right? And the S&P captures about 80% of the US stock market. I think it's 79.6 to be precise. And so, we decided, well, okay, let's look at the total market, right? And we looked at the total market, and the total market's, around 5,000 stocks, 5,600, I think. A lot of those stocks are on the pink sheets. Some of them are so illiquid, they trade by appointment. So does it really make sense to include those stocks that can be easily manipulated? We decided to choose the S&P 1500 to run the study on this week. And the S&P 1500 captures over 90% of the market and the most liquid investable stocks. And so when we look at the long-term trend following model on the S&P 1500 composite, it still has not registered a buy signal or a positive change. And so we continue to be on a negative signal for the long-term trend model.
So, first of all, I would have quite happily accepted your rounding of 80%, but 79.6, that's why you do what you do. And I'm always impressed by it. Let's talk some technicals. Let's look at the primary degree Elliott wave count and how your preferred versus alternate counts are looking.
Yeah, so, we've been playing around with primary degree, the count off of the January 4th, 2022 high. And our primary wave, or primary degree Elliott wave count suggests that we've declined in 5 waves. The question is, how do we count the recovery, right? And just to kind of put it in perspective, the preferred count, which is on the left-hand side of this chart, illustrates really the initial decline from the January into the June low as being primary wave 1 down. And the rally into the August high is primary wave 2 up. So that means we're already in primary wave 3, but primary wave 3 appears to be subdividing an intermediate degree of trend. We've counted the October low as intermediate wave 1 down, and last Thursday's high at S&P 4195 counts to actually, it traded up to nearly the 78.6% Fibonacci retracement level. And, the count is a perfect double zigzag. It actually counts as a single zigzag as well, but it's a little disproportionate. We like the double zigzag view better, so that's what we're illustrating. But the point is that probably was intermediate wave 2's top, the peak of intermediate wave 2. And so since that time, we've been falling, and the initial decline was a very small 5-wave decline. It's tough to really suggest that that's indicative of a third wave decline in progress. There's a possibility we could get another push higher. There's an unfilled chart gap at 42.28, and the Fibonacci 88.6% retracement, which is the square root of the 78.6% retracement. That comes in at 42.30. So that's, a potential magnet for prices. But I really feel like we've reached a point where we're running on fumes. There's just not much gas in the tank. I think the rollover that we saw from that 41.95 is highly probable that we're beginning a third wave decline. If we close below 40.75 on the S&P 500, I think that's a pretty good indication to support that conclusion. Once we take out the December 22nd low, that would confirm it definitively. Now, we have an alternate count. And by the way, we're ascribing about a 60% probability of the preferred count. The alt count, which is on the right-hand side, suggests that, well, since the June low, the primary wave one low, we've actually traced out a flat. And that would put the August 16th high as wave A, the October 13th low is wave B, and probably we're in the midst of a wave C advance that still has some more upside to it. And if in fact that upside carries above the August 16th high, then we could expect it to push meaningfully higher to around 45.64 maximum before we draw the line in the sand and say it's wrong. But I only ascribe about a 30% probability to that. I would much rather wait and see that we break out above that August 16th high before I start, planning my portfolio around a rally to 45.64. I just, I don't think that's a high probability at this point. And with that, we're kind of focused on the preferred count at this point.
Right, so definite focus on the preferred count. How about, I think this is, in this type of market, I feel like there's a lot of focus on short-term levels. Where are you kind of seeing, looking at this chart on the short-term Elliott wave count, what do you think here?
Yes, so this really details what I was just saying about, the double zigzag. WXY is how we've labeled the advance off the October 13th low. And what you're looking at really is everything since the August 16th high here. And so you can see intermediate wave one down, intermediate wave two up. And then with yesterday's market action, we're now toward the lower boundary of that trend channel. Actually, we've challenged the lower boundary of that final trend channel. And so my suspicion is that we're going to carry through that. Again, a break, a close, a daily close below 40.75 would strongly support the conclusion that this chart suggests. And then again, if we take out that December 22nd low, that would confirm definitively that a third of a third wave decline is underway. And it should not be a question in anyone's mind at that point. We should be looking at a fierce decline that should be carrying aggressively lower. And as we illustrated in the other charts, the downside really is into the mid-2000s.
Got it, mid-2000s. Again, scary as always. So let's move back up to 30,000 feet. How do the market internals look? Actually, I guess that's kind of going back from 30,000 feet back into it. But let's talk market internals. How are they looking?
Yeah, I think they're diverging. If we look at the breadth, which is really a 5-week, moving average of advances less declines in the S&P 500, not the broad market. This is just the S&P 500. And what we saw is a negative divergence. Okay, price made a higher high, but the 5-week moving average of the net advance decline measure made a lower high. And so that leaves us a little bit dubious about, this big breadth thrust that everybody's been talking about on the Twitter sphere. Now, momentum did poke its head up a little bit above the August high and above the November high. And so that's a positive, but it's nowhere near prior highs. It's still, barely overbought at this point. And so, we've seen momentum move sharply in both directions. It would not surprise me to see momentum fail here and reverse back down. And typically that's what you want to see, a reversal back out of overbought into neutral would, be convincing that we're getting a momentum reversal. But I would say the tiebreaker between these two is volume. Last week's up volume was really just only about 30% of total S&P volume. That's de minimis. If we look at the 5-week moving average of the up-down volume ratio, it's still pretty high, 8.4. but it's below the August highs. And so again, another negative divergence in place with the internal. So, it leaves me at least questioning the veracity of the technical call that we've got such strong internals here. They look like they're strong, but not strong enough, right?
Got it. And we discussed this earlier in the show, greedy pigs. Let's talk investor sentiment here.
Well, yeah. So again, another sentiment indicator, this VIX indicator that we've been following, another relationship that seems to be germane right now is that, when the VIX gets low and reaches the levels that it's at, down in kind of the high teens where it bottomed on November 1st, or on February 1st, rather, that tends to coincide closely with peaks in the S&P 500, and the S&P 500 peaked on the 2nd of February. So we're a day apart. And if we look back in the history over the last 12 months, every peak is attended by a trough in the high teens in the VIX. And so usually when the VIX closes back above its 21-day moving average, that confirms a reversal is in process. Now, we didn't quite get there yesterday. We tagged the 21-day, but we closed below it. So we'll find out in the days ahead whether this is all correct. And if in fact we do see the market continue to, slide lower, I think it will be attended by a VIX that is aggressively pushing above its 21-day moving average and confirming that reversal in, what is currently what I would describe as complacent investor sentiment.
Oh, got it. And let's have a look year to date. What sectors have kind of been at the forefront of this rally?
If we look at the S&P 500 GIC sectors, it's been led by communications, discretionary, and tech. But within those three sectors, there are three stocks that are standouts. In communications, it's been Meta Platforms, formerly Facebook. Within discretionary, it's been Tesla. Tesla's had an absolutely astounding rally off of its recent lows, confounding the bears who have been very vocal, ourselves included to some extent. We're no longer short the stock, obviously. And then technology has been led by, believe it or not, NVIDIA. The semiconductors have been strong, but NVIDIA has been one of the big leaders there. And so, it's not surprising. Those three stocks had relatively interesting reports. Actually, NVIDIA doesn't report for another couple of weeks yet. But, I think the moral of the story is there are some good stocks that are driving this. But within the grand scheme of the rally, I think, Michael Santoli summed it up when he announced last week that Goldman Sachs had pointed out that hedge fund short covering had reached a new 10-year high, the highest short covering activity that they'd seen in their hedge fund group, in more than a decade at this point. So that suggests that a lot of this rally has been, a capitulation by the bears, and I think that part of it's over. And so the onus is on the bulls to carry the ball. And I just don't see a lot of Meta and a lot of Tesla type earnings reports coming out right now. We'll find out if NVIDIA can carry the ball the extra yardage when they report, I believe, on the 22nd.
So that's thank you for that overall kind of overarching look. Let's dig a little bit deeper into the tech side of things. Obviously, they've been at the forefront of this rally. How do things look in the top performers versus the Nasdaq?
Yeah, so we looked at the Nasdaq 100, and of course, this risk on sort of mania that's developed since this December 22nd low, in our view, has really kind of catapulted all of the old FANG MT names back to levels that had previously kind of been left in the dust, right? And if we take a look at just valuations on these, valuations are back near their all-time highs. And one of the reasons for that is earnings have collapsed for these guys. If you take a look at fourth quarter net income growth, and all of them have reported with the exception of NVIDIA, it's all negative except for Tesla. Tesla put up a 60% positive net income growth number, but obviously much, much earlier in its growth cycle than some of these other names. Most of the companies, even Meta, for example, had, I think, down 52% net income growth. The stock's trading at 22 times. It looks cheap relative to the rest of the group. I guess that's debatable. 22 times doesn't really seem cheap in the grand scheme of the market. But, when you're taking a look at companies that are trading at, 85 times or thereabouts, like NVIDIA, you have to, question, whether or not there's, whether or not the tail's wagging the dog here. We'll find out soon, right?
We'll definitely find out. And you're throwing up a bunch of question marks. I feel like there should be a load of question marks all over my head right now. But how do we make some money in this? You obviously have your top picks for the week. Let's dive in. Let's get some picks out.
Sure. Let me just front run the picks by saying that we continue to like the healthcare sector as kind of a GARP play. It's defensive, but it's also got some growth in it. Within the healthcare sector, we like Stryker, which is an orthopedic products company. Stryker went out, I think, around 271 last night. We think if the stock can break out above 276, it's been above there, closed above there last Friday on a weekly closing basis. Yesterday's pullback maybe creates a buying opportunity. We prefer to be long the stock above 276. That breakout really looks like it's resolving a deep cup base, and that resolution counts up to around 364 in terms of our measured move target. We would use a stop loss of 256, so about $20 below our entry point. That creates a very attractive 4-to-1 positive risk skew for traders looking to play that swing to 364.
Do you have anything on the short side that jumps out?
Yeah, on the short side, we continue to be bearish on discretionary. It's the second most bearish sector in our sector work at this point. And within discretionary, electronic arts is a standout on the short side. The stock closed at 112 last night. It broke down below 115, which resolves a inverted cup and handle top formation. And that pattern counts to about $80 on the downside. We would use a stop loss at, say, 122, 124 range. 122 would get you a 3-to-1 positive risk skew. So if you like the, I prefer to really kind of set myself up where I've got at least 3 times more to gain than I have to lose. And so that 3-to-1 positive risk skew is more important to me than the technical significance of, the couple dollars higher.
Fantastic. Jeff, I've missed this. I'm so glad to be back with you talking stocks and listening to your advice on how we should be positioning ourselves. So welcome back.
Well, that makes 2 of us. Thanks for having me. It's great to be here.
Absolutely. And we appreciate your thoughts from Alpha Insights, and I want to thank our viewers. And I would urge our viewers to check out Jeff's content on Substack at hugeinsights.substack.com, and you can see that right there. Until next time, don't forget to subscribe to your finance.tv, and good luck investing.